Hello everyone, thanks for checking out my video. We had a little bloodbath last Friday as major indexes slumped, ending the week with a loss. The sea of red in the stock market saw more than 900 billion market value being wiped out. It was the worst day of 2025 so far, even though the year is still young. The latest sell-off came amid concerns about an economic slowdown, impact of Trump's tariffs policies, and a potential new coronavirus that could infect humans. With that, we have seen a sell-off in the market for 4 out of the last 5 Fridays. Is that the norm to sell off on a Friday now? Will buy the dip investors step in again? Lots of things to unpack, so be sure to watch throughout the video to find out more. Okay, so most US stocks took a huge hammering and fell sharply towards the closing bell last Friday. The uncertainty surrounding tariffs, the possibility of a slowing economy, and the renewed threat of inflation might have caught up to investors, leading them in search of safer assets. Here's a breakdown of the negative news we had last week. So basically, the latest University of Michigan Consumer Sentiment Index showed that consumers are pretty concerned about higher inflation ahead of possible new tariffs. The new reading tumbled to 64.7 at the end of February, which is a decline of nearly 10% and a steeper drop than expected. On top of this, existing home sales in the US also dropped more than expected last month to 4.08 million units. And then we had the US Services Purchasing Managers Index also fallen into contraction territory for February. That's not the end. Earlier last week, we saw Walmart issuing a weaker than expected forecast, which soured the outlook for both the consumer and US economy. All this new US data has sparked concern among investors over a slowing economy and sticky inflation. What didn't help with the stock market was that according to Bloomberg, some investors were spooked by reports emerging that a Chinese team found a new bad coronavirus that could infect humans via the same route as COVID-19. As a result, the market had a sharp sell-off towards the end of Friday, which sent the major indexes into the negative territory. The S&P 500 suffered its largest single-day percentage drop since 18 December last year, and every stock in the Magnificent Seven was red to end the week. Meanwhile, I think it's also worth highlighting that there were $2.7 trillion worth of options expiring last Friday. That might have also contributed to the sell-off. Why I say this is worth highlighting is because if it was just an options game for the market makers, then the market could recover in the new week ahead. Furthermore, don't forget, in the recent 3 Fridays where we saw a sell-off, the market recovered almost immediately the following week. It seems like investors have been trained to buy the dip. So how do we know which is which? Well, pay attention to the key support and resistance levels of the S&P 500, which I will cover in the technical analysis segment. Okay, before that, let's move on to market outlook. The biggest talk for the new week ahead is none other than Nvidia's earnings on Wednesday 26 February. Their performance and forecast will be a reality check for Wall Street, especially when most investors are having that bit of anxiety caused by the release of DeepSeek. It's definitely a tough setup going into the conference call this coming week because all eyes will be on the guidance Nvidia provides for both the supply and demand for its chips to justify its very own rich valuation as well as the AI sector's outlook. Basically, Nvidia is like the last piece of the puzzle right now that might help to shape or determine the next market direction. On the very same day, 26 February, notable names such as Salesforce, Snowflake and eBay are also reporting their earnings. Another earnings that investors might be paying attention to is Home Depot, which will be reporting a day earlier on Tuesday 25 February. Their conference call should be able to provide some insights into the latest consumer spending patterns, which are affected by factors like interest rates and inflation. Separately, investors will also be closely monitoring the release of the new PCE data on Friday, which is also known as the Fed's preferred gauge of inflation. This data is pretty important at this point, as the recent CPI and PPI data showed that inflation increased by the most in the last half a year. And so, if we get another hotter than expected inflation data, it would mean the Fed has to wait longer to cut interest rates, and the market may not like it. Alright, let's move over to the technical analysis segment. To recap, in my last video, I shared that I was expecting the bullish momentum to bring SPY above 611 or 612 to create a new all-time high. Look at the chart, SPY went to 613. I hope that could earn me a like button. Okay, but got to be honest, I didn't expect that late Friday sell-off. I mean, who would have predicted that, right? Anyway, earlier on I posed the question of whether buy the dip investors will step in or the latest pullback will continue, and how do we look for confirmation. So here's your answer, watch that 50 moving average closely. As you can see on the screen, for the past few sell-offs, SPY had managed to bounce off the 50 moving average, which shows how strong a support this is. But it also means that if SPY starts closing below this moving average, which currently sits at around 599, it spells trouble. Because when that happens, I think there is a decent odds that it may continue to slide further, probably towards the critical 61.8 Fibonacci level at around 590. That's roughly where the 100 moving average is as well, which forms a double support. The area is important for the bulls to protect, because if SPY loses it, I would expect that gap to be filled. The range of the gap is between 585 to 589. On the other hand, if we want the bullish momentum to resume, SPY needs to stay above 50 moving average and retest 610 again. I guess it's kind of obvious that a close above 610 would almost naturally brings us to the all-time high at 613. That's when we could see a new record high. Above 612 and 613 level, the next resistance level is 618. Let's now have a look at Apple's chart. So last week I shared that if Apple can continue to close above 244 and take out that intraday high of 247, we could see 250. Well, it went as high as 248.7. Almost there, but not there. Gotta be honest with everyone so that I don't just show the things that I got that right. Anyway, do we still have a chance to see 250 this week? Okay, not trying to flip my words, but I am wary of that candlestick that was printed last Friday. That one, to me, looks like a bearish shooting star pattern. For confirmation of this bearish pattern, watch for the candlestick on Monday. Look out for increased volume selling pressure and a potential drop below the low of the shooting star candlestick, which is 245. If the bearish trend is confirmed, then we can say goodbye to 250 because I think Apple could potentially slide towards the blue support line at 237. If this support level breaks as well, I do think Apple could see 220's range again. Okay, in terms of the bullish thesis, if Apple can invalidate that bearish shooting star candlestick and continue to stay above 244, then my last week's thesis of Apple hitting 250 is still intact. Just to add, the longer it stays above the 61.8 Fibonacci level, the more bullish it is. Jumping over to Tesla's chart. So last week I specifically mentioned that I was cautious about the latest bounce in Tesla's share price because it hasn't reclaimed the 364 resistance level. I also said that if we lose 350 support level, 320's range could be in play. Okay, let's break that thesis down. So as you can see, Tesla really faced some resistance near the 364 level. It just couldn't close above it. And the next thing we knew, it lost the 350 support level and we are at 330's range already. This means that my bearish thesis is still intact and therefore don't be surprised if we see 320's range this week. Just to add on to that, the MACD did a reversal. It basically wanted to have a bullish cross last week, but ended up curling down again, and that's a bearish sign. For the downside, pay very special attention to that critical 61.8 Fibonacci level and around 317. If that breaks, I do think Tesla could waterfall down to sub 300 at the very least. Honestly, at the current level, I do think bears are smelling blood here. But well, I could be wrong and I always stand corrected and don't mind to be corrected. So if I am proven wrong and Tesla decides to reverse its current bearish trend, it needs to do at least one thing. Okay, before that, again, spare me less than 30 seconds. If you would like to support this channel and at the same time are looking for a new brokerage account, do consider Longbridge. You can use my referral link to sign up, deposit 2,000 Singapore dollars, maintain the fund for 30 days, make 3 separate buy trades, and you will get a free Nvidia share. There's also additional $18 cash coupon for you if you sign up using my link. Thank you. Alright, back to business. Where was I? Alright. Tesla needs to do one thing to reverse the bearish trend, and that is reclaim that 364 level. It needs to close above it for at least 2 days and not just an intraday peekaboo by going above it briefly only. If we can get a solid close above 364, I do think the probability of going back to 380's range is pretty high. That's when I think my bearish thesis can be chucked aside for now. In fact, at 380's range, I wouldn't expect the bullish momentum to start. From there, it may just charge towards the 50 moving average at 400. Actually, I'm just thinking, what if both the bullish and bearish thesis play out this week? Say, Tesla drop to 320's range, rebounds, and then go above 364. I don't know, this is only a random thought, not a financial advice of course. Moving over to Google's chart, Google was consolidating in this tight range for a while, and right now it seems to be breaking down as it has breached that 181 support level. Okay, not financial advice, but I am paying very close attention to Google this week because I do think there could be an opportunity for me to either sell put option or pick up shares. So with Google falling below the 181 support level, I am of the view that there is a decent probability that Google might test that 200 moving average at around 175. That's where the 123.6 Fibonacci level sits as well. Again, I need to clarify, technical analysis is no crystal ball, it's all about probability. I cannot be certain that Google will go near or hit the 200 moving average. But if it does, I am seriously considering taking some action, just for one simple reason, and that is, this 200 moving average has been a very strong support level since March 2023. That's a good 2 years ago. There were a number of times where Google tested this moving average and rebounded off it. The biggest scare was in September 2024 where Google fell below it for more than a week, but still, it went back up. Furthermore, if Google continues to drop from the current price to the 200 moving average, the RSI would have been oversold. With that, I do think this is a really good opportunity to step in. But again, I need to emphasize that's just for me. That's my personal view and not a financial advice to you. Please don't go all in or execute any trade because I said so. Alright, on the other hand, for Google to be caught bullish, while we have a long way to go. So let's take one step at a time. First of all, it needs to get back above 181, but for bulls to have a bit of hope for reversal, it needs to close above the blue line, which is around 188. But those are just baby steps for a reversal in trend. For us to say Google is bullish again, it needs to reclaim the 50 moving average at 192. That's also where the critical 61.8 Fibonacci level is, which also means it's a double resistance level. Reclaiming a double resistance level is like staking a claim that the bulls are back. Moving over to Meta. For Meta, I really had to bring back what I shared last week. 3 main things. I specifically shared that I was leaning towards the bearish camp. I then said that the probability of a retracement is high, and don't be surprised if Meta falls below 700. And tada, there you have it, the chart printed only red candles for the entire of last week. This came after the share price closed higher for 20 consecutive days. I hope this could earn a like button from you. Alright, for this coming week, it's tough to predict where will the pullback stop. Honestly, any of the Fibonacci retracement levels you see on the screen can be a potential area for a bounce. Okay, I know by saying so, it's not value adding to anything. Well, perhaps watch out for 660 and 641. 660, which is the 50% Fibonacci retracement level, is a typical level for a share price to resume its main direction, and for this case, it's up. As for 641, it's one big important level because it is formed by the critical 61.8 Fibonacci level and the 50 moving average. Watch this level like a hawk, because if Meta loses it, can you see that consolidation area? Meta may move within this range, which means there could be more downside towards the low 600s. I know it's a bit of a long shot for the bears, let's see. As for the bullish thesis, again like I said, a bounce off any of the Fibonacci level gives us a chance to see the bullish momentum continuing. If I were to choose a level, then perhaps watch for 700, which is the psychological level, or maybe stretch it a little bit to the 23.6 Fibonacci level at 703. If Meta can close above 703 with nice green candles, then the bullish momentum is back. That could send Meta to the 720s range again. Okay, let's move over to Microsoft. Microsoft's chart looks a little tricky at the moment. Prior to last Friday's sell-off, it printed 8 consecutive green candlesticks. On top of this, the MACD had a bullish cross. These are all bullish signs. But unfortunately, just when we thought Microsoft was about to push higher, last Friday's market-wide sell-off has made things a little more complicated. Because that sell-off has denied Microsoft's breakout and we are still stuck in this consolidation area. Anyway, for the downside, 2 key levels or areas to watch. The first is 404, a level which Microsoft rebounded off previously. Below 404, watch that green support line at 396 and perhaps stretch it a little bit more to 392 where the 123.6 Fibonacci level is. The last line of defense lies at 385. This is one area that I will definitely consider picking up some shares. But the risk is that once 385 breaks, it's waterfall time. So be very careful if you wish to step into. Alright, in terms of the upside, it's kind of straightforward. First of all, obviously Microsoft needs to break out of this mini consolidation area. To do so, it needs to reclaim the 61.8 Fibonacci level at 424 at least. Coincidentally, that's where the 200 moving average is. So therefore, a close above 424 is quite a bullish sign in my opinion. But for us to see a bigger breakout, then I think Microsoft needs to reclaim all 3 major moving averages, which are 200, 100 and 50. A solid close above all 3 levels could give us a decent probability to close that huge gap, which ranges from 422 to 439. It may not close the gap entirely, but I think 430's range is very likely if we can reclaim that 3 moving averages. Finally, let's have a look at Nvidia's chart. A big week for Nvidia. The company is reporting its earnings on Wednesday 26 February after the market close. Based on this Options AI website, the expected movement post-earnings is about 8.5%. Looking at the past post-earnings movement, it's actually quite a wide range, from 0.5% to 16%. Anyway, a 8.5% movement to the upside is around 145.9, while a 8.5% movement to the downside is roughly 123. With that being said, take these numbers with a pinch of salt because a lot of times this implied movement tend to over-predict the actual movement. So let's look at the key support and resistance levels instead. For the upside, watch that 61.8 Fibonacci level and around 138. Again, just like Microsoft, Nvidia was looking bullish by climbing above it and closed above it for a few days, but last Friday's sell-off spoiled the bullish momentum. Therefore, for Nvidia to be bullish again, it needs to close above it once more. But for a better confirmation, the bulls would want to see Nvidia climbing above the purple downtrend line. That's what we call price action, which is quite simple. As you can see, Nvidia has been creating lower highs, so that's bearish. Hence, if Nvidia can break this lower highs trend and take out that recent high of 143.44, then I would say there is a decent probability for Nvidia to retest 150. In fact, that's higher than the 8.5% upside predicted. But here's the but. Even if Nvidia is bullish this week, it doesn't mean it will hit 150 this week. It takes time for price action to play out. As for the bearish thesis, I think if Nvidia wants to fall and if market makers want to dump shares, I think Nvidia will easily head towards the 200 moving average at 125, which is very near to the predicted 8.5% downside at 123. Okay, not financial advice, very similar to Google, at 200 moving average, I may step in. But I must say, it all depends on how bearish Nvidia gets during post-earnings. If there is a massive sell-off, I may let it fall below 200 moving average before stepping in to sell put options. Honestly, at this point, I still can't bear to pull the trigger to pick up any Nvidia shares above 100 since my cost price is only $21. I may eventually do so above $100, but maybe just not now. Okay, let's now have a look at my options trade. 2 trades to update this week as summarized on the screen. So the first one to update is this new cash secure put on Microsoft, which was sold last Friday 21st February. The strike price is $3.85. This is the third time I sold a Microsoft put based on the strike price. There were a few reasons for selecting this strike price. First of all, I don't mind getting a side with 100 Microsoft shares at $3.85 per share. The other reason is because $3.85 is a good support level, giving it a decent probability for Microsoft to bounce off from this level. To add on above $3.85, we do have a few other decent support levels too. Anyway, the reason why I pulled the trigger last week was because Microsoft tested the low 400 support level for a number of days, and then it rebounded just like how it did in the previous occasions. In addition, the MACD had a bullish cross on Thursday, and so I decided to step in on Friday. But unfortunately, there was a market-wide sell-off towards the end of the day, and because of that, the trade is currently sitting on a paper loss of about 44%. It's nothing, like I have always shared, I have seen how a trade can easily swing 100 to 200%. Anyway, the contract still has more than a month before it expires, so let's see how it goes. Moving on, the second trade to update is this cash secure put on Apple, which expired last Friday 21st February. This contract was sold on 10 January with a strike price of $2.15. There were a few reasons why I stepped in to make this trade, which are summarized on this screen. Namely, there was a sell-off in the market and Apple was hitting the oversold level on the RSI. The sell-off also brought Apple to a decent support level. In addition, there was a rise in implied volatility, which is good for option sellers. All these are pointing towards a possible rebound in the short term. If you want to understand a bit more of my full thought process behind this trade, I have covered it in my earlier video, which I have linked it at the top right hand corner. Anyway, after I sold the put contract, unfortunately Apple went on to drop further in the next 2 weeks and went as low as $2.19, almost hitting my strike price. But fortunately, it then rebounded and it closed out last week in the $2.40s range. In other words, the contract expired worthless and I got to keep the full premium of about $200 without having to close the position. Okay, sharing some of my quick thoughts. The positive and upbeat mood seen among US investors and businesses at the start of the year have seemed to have faded. Wall Street is now grappling with uncertainties around persistent inflation, Trump's tariffs, a slowing economy, and possible declining corporate profits. So, is it time to panic? Alright, here's my take. It's not the time to panic, but it's definitely the time to stay cautious, especially if you haven't been doing so since Trump took office in January. The key reason? Volatility. I have mentioned multiple times in my videos that investors should expect volatility and sharp market swings this year, at least in the first half, as the world braces for Trump's tariff policies to take effect or ramp up. To me, the recent sell-off is a wake-up call for both consumers and investors about the impact of Trump's tariffs. While these tariffs may never be fully implemented, consumer caution is already reflected in sentiment surveys and their spending behaviors, as reported in various companies' earnings calls. Apart from preparing for volatility, there's one more thing that investors should mentally prepare for, and that is inflation taking up again. In fact, we are already seeing early signs of this. And what does that mean? It means investors should adjust their expectations for rate cuts this year. Fewer cuts means higher interest rates are likely to persist in 2025, which could hurt corporate profits. If that happens, the current rich valuations of many companies might not be justified. To put it simply, sell-offs in the market, like the ones we have seen on recent Fridays, could become more frequent, unless of course companies find ways to boost their profit margins in this high interest rate environment. Okay, now in case you're wondering, I'm not here to spread fear, alright? I'm here to give you a heads up so you can mentally prepare for volatility, sharp price movements, and sudden sell-offs in the market. And when you're mentally prepared, you will be less emotional when the market swings, and probably more willing to take advantage of the opportunities to buy strong companies at discounted prices. Unfortunately, many traders and investors actually freeze up or hesitate to buy during extreme volatility. They don't dare to pull the trigger to buy. But those who stayed prepared or were mentally prepared, they won't be caught off guard. And one last thing, at the moment, if we were to stretch the time horizon to 1 year or even the next 4 years under Trump's administration, barring any black swan events like a new coronavirus outbreak, I remain bullish until proven otherwise. I'm pretty much unfazed by this short-term volatility and sell-off. But with all that said, I am interested to have a sensing of what's everyone's interpretation of the latest sell-off. Do you think it was expected and reasonable? Or is there something deeper brewing in the market? Let me know in the comment section below. Last of all, if you found this video useful, don't forget to tap the like button and I will see you in the next one. Thanks for watching.